Earlier this month, the Federal Reserve quietly published a research note that governments, facing swollen debts, are studying whether to fund themselves by revaluing their official reserves by using gold. According to the Federal Reserve, with public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes, while also not increasing public debt outstanding. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the U.S. For the U.S., this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. The report reviews how countries like Germany, Italy, Lebanon, South Africa, and even tiny Curaçao and St. Martin have dipped into their reserve revaluation gains, the paper profits from rising gold and currency values, to buy themselves time when fiscal pressures mount. Sometimes, the proceeds were used to cover central bank losses, like Italy's €13 billion maneuver in 2002, or Curaçao's creative gold transactions after 2021. Other times, governments themselves seized on the windfall to shrink debt, as Lebanon did in 2002, channeling revaluation gains worth a staggering 11% of GDP. Reserve revaluations are a quick shot of liquidity, not a cure. They can plug short-term holes, stave off embarrassment, or ease political pressure. But they don't solve the structural reality of chronic deficits.